Wells Fargo stock has a PE under 10. It has a dividend yield over 2%, and that continues to rise. Management said today that they have plenty of capacity to buy back the shares and continue to raise the dividend. So why in the heck year to date is Wells Fargo stock down over 19%? We'll talk about that and more on today's show. What is going on, investors? Hopefully, guys are doing well out there. Earnings season rolling right along as we move into the financial stocks, as we talk about Wells Fargo, as they reported their Q2 earnings before the bell. The stock is reacting very nicely, up over 5.8% to be about $41 per share. We'll certainly talk about this from a technical perspective in a moment, but I want to get into these Q2 numbers, which came out before the bell. Revenue came in at $17 billion, a shade over $17 billion. That was a decline, actually, and we'll show you some of the reasons why. And quite frankly, you as an investor should really be able to think right off the top of your head, why did revenue decline 16% year over year to this $17 billion? In fact, they missed expectations on that revenue by about $510 million. You as an investor should really be able to understand why Wells Fargo revenue is actually declining year over year, but Wall Street not only expected it, but are rewarding the stock today with a higher price. We'll talk about that if you don't understand this right off the top of your head. Now, first thing that we got to realize is with all of these financial institutions, including Wells Fargo, is we've got a pretty low growth on that revenue side. In fact, Wall Street anticipating over the next 2 quarters for revenues to continue to contract year over year. Wall Street is expecting this to reaccelerate a little bit heading into 2023 and 2024. What is really expected to accelerate over at Wells Fargo are these earnings. In fact, this is accelerating, according to many analysts, well into the double digits in terms of its earnings growth. We'll talk about more of that here in a second. But Wells Fargo sees 2022 net interest income growing 20% over the next year. That is obviously due to higher interest rates over at Wells Fargo. That is what's going to spur likely the fact, even though this company's revenue growth tends to be a little bit mediocre, maybe even in contraction mode, those earnings growth should accelerate because you have those higher interest rates. Certainly will benefit all banks, but including Wells Fargo as well. One thing that I wanted to note was comments by the CEO. I think this is a great quote. He says, looking ahead, our results should continue to benefit from the rising interest rate environment, something that we just talked about, with growth in net interest income expected to more than offset any further near-term pressures on non-interest income. We do expect credit losses to increase from these incredibly low levels. I think that's probably the key sentence out of all of this, is the fact that we've had incredibly low credit losses, which is people defaulting on their credit card loans, their home loans, and all those types of things. He says they have yet to see any meaningful deterioration in either our consumer or commercial portfolio. So a lot of the talk, look, I've been talking about it here on the channel. Every economist out there is talking about the fact we might be in recession. We're going to go into recession. Well, the CEO of Wells Fargo is saying, look, we have yet to see any material deterioration in terms of credit losses in their portfolio. But I'll show you the fact that they are down 16% year over year on that revenue side. They are seeing deterioration of demand for loans. Obviously, when you see a rising interest rates, at least in the shorter term, it will kick some people to the side. They're not willing to borrow money at 5% on a mortgage or a car loan. Those things can be shorter term. We'll see how that shakes out with all of these banks. Now, Wells Fargo did stand out from most of the other banks. A few weeks ago, we had the results of the stress test. Wells Fargo, Goldman Sachs, Morgan Stanley, a few others decided to boost their dividends, while Citigroup and JP Morgan decided to pause them, and Bank of America gave you kind of a small token rise of that dividend. Wells Fargo saying that they have significant capacity to execute on common stock repurchases, which will be routinely assessed over at Wells Fargo. We'll get to those financials here in a second, but I do want to talk a little bit about Wells Fargo's valuation. Been talking about with all the banks here, we've got a price to tangible book. Essentially, if you were to liquidate Wells Fargo's assets, you would get very close to about $40 per share on this one. So this one's trading not at an excess or a strong premium. It's still trading at a small premium to book. Anything over 1 times tangible book is a premium to the book of the business. And when you look at like a JP Morgan, certainly like a Bank of America, they're trading a significant excess over their book value. We just looked at Citigroup. They actually trade almost half of their book value. Wells Fargo trading almost perfectly even with that. So we'll see evidence of that when we get over to the financials. So we had those total revenues over at Wells Fargo in the most recent quarter. We talked about how they came in at that $17 billion. That was a 16% decline year over year. You see here last year, they were at closer to $20.3 billion. Last quarter, even in Q1, they were at $17.6 billion. So we're seeing quarter over quarter, we're seeing declines, and we're seeing even larger declines year over year. But just like the CEO said, he is not seeing a deterioration in consumer credit. They went from $379 million worth of net charge-offs last year. And those actually went down. Now, they are up quarter over quarter, but this is still historically low charge-offs when it comes to these loans. But for whatever reason, the Federal Reserve and the banking requirements are starting to make these companies like Wells Fargo, like JP Morgan, like Bank of America next week, and certainly like Citigroup, they are making them set aside more money for credit losses just in case the economy takes a turn for the worse. You see, back in Q2 of 2021, they actually got to pull from their piggy bank of reserves over at Wells Fargo over $1.2 billion. Last quarter, even just a quarter ago, they pulled $787 million from their credit losses provisions, which means they thought things were going pretty good. Well, that all of a sudden took a turn for the worse as you see interest rates continue to rise. You see inflation continue to rise. There is some concern. There's a lot of concern, quite frankly, on the health of the economy. Obviously, you've seen equity prices decline as well. There's certainly predictions out there that home prices will continue to fall as well, or start to fall, and that certainly could impact negatively Wells Fargo. You see, they set aside $580 million. You have your non-interest expense coming in at $12.8 billion. What we're seeing, a slight deviation from Wells Fargo from a JP Morgan. They've actually lowered their non-interest expense. So we did see over at JP Morgan, their revenue also declined just like Wells Fargo, but JP Morgan's non-interest expense actually climbed, whereas they're actually seeing the opposite was Wells Fargo. They're doing a nice job. They went from $13.3 billion in costs down to $12.8. You're even seeing it on a quarter over quarter basis. They're doing a nice job controlling those costs that might give them a little bit more leeway into those buybacks, those dividend increases, whereas you're seeing the opposite over at JP Morgan. Pull down into that net income number, and so despite the decrease in interest expense, the combination of provisions for credit losses instead of actually taking a credit for them, and on top of that, the pretty significant declines in revenue, you did guess the net income is declining over at Wells Fargo. In fact, down nearly $3 billion year over year from over $6 billion, cut nearly in half down to $3.1 billion. You're seeing your diluted earnings per share also essentially cut in half year over year. Now, what is causing the decline in year over year revenue over at Wells Fargo? Well, a lot of it has to do with the fact that you have interest rates ticking up. And take a look at home lending. We've got our our consumer banking and lending. This is your average person out there getting a home loan, getting a credit card, getting an auto loan from Wells Fargo. Look at home lending over the last year, folks, down to $972 million. Folks, that is a $1.1 billion decline over this time last year. And it's over $518 million less than what we saw in Q1. We're seeing massive declines in home lending. And obviously, all of that has to do with the fact that you have interest rates climbing on that home mortgage side from about 3% last year to over 6%. I think it's walked back to closer to 5% in more recent days. Now, shorter term, that's obviously a headwind in terms of these revenues. I think what Wall Street, the fact is Wells Fargo stock reacting very nicely to these results in a lot of ways. And in fact, in all ways, this was anticipated by Wall Street. In fact, you're going to have massive declines in home lending, at least in the shorter term. I think what Wall Street's starting to do, and I think a lot of investors should start to do this as well. Let's assume, and this is very difficult to assume, but let's assume that home mortgage interest rates start to stabilize. For a decade, they stabilized kind of at that 3% and maybe even south of that for a while. Let's assume maybe for the next decade, we can maybe stabilize at 4 or 5%, maybe even as high as 6% on that home lending side. Well, that will be a massive tailwind because at some point, consumers will get comfortable with a little bit higher rate, just like with inflation. Consumers eventually get used to it. It's not necessarily good for the economy, but eventually they'll get used to it. And those price increases will eventually get passed down to the consumer and they'll end up eventually eating them. Same thing on the home lending side. Credit cards, we're not necessarily seeing a deterioration there as you'd expect in an inflationary environment. In order to maintain kind of your wealth or your lifestyle, maybe you're putting a little bit more money on credit cards. We're seeing an increase year over year and quarter over quarter. Automobile loans, we're still seeing an increase over last year, but down a little bit from the previous quarter as well. We're seeing personal lending also start to decrease, although that is up year over year as well. Personal lending, automobiles, relatively small portion of this company's business. It's really this home lending. If you were to somehow be able to reaccelerate this, not only reaccelerate it, but reaccelerate it at a 4, 5, 6% mortgage rate, that would be I'm talking about incredibly bullish over at Wells Fargo. You're seeing net income side from the consumer banking came in at $1.4 billion. Folks, that is $745 million, less than where you were last year. That is a massive decline. And even over quarter, you're down over $377 million. Now, the other large business that Wells Fargo operates in is corporate and investment banking. And we're seeing relatively neutral or flat numbers on that. Surprisingly, commercial real estate, which if you drive around, is just in the dumps, it seems like, that is still up year over year and quarter over quarter as well. I don't know who's borrowing money or lending money on that. I guess Wells Fargo is. There must be some projects out there that can get some tenants in the door on the commercial real estate side. All things being considered, though, yet about $1.33 billion worth of net income on this side. It's down fractionally year over year on a quarterly basis, but up marginally quarter over quarter. All things being considered, about what you'd expect on the corporate side. It's really this home lending side that really took it on the chin. And I think some investors think, well, look, that's probably going to carry over into maybe the whole back half of 2022. But I think as you move into 2023, I think what we might see on that home side is see a little bit of price correction. Maybe you get some, I wouldn't necessarily say massive declines in home prices, but they start to stabilize. They don't go up as fast because home mortgage rates just continue to rise and kind of offset any price decrease that you see in the market. So we'll see what happens on the home side. I would be monitoring that very closely if you were an investor into Wells Fargo. The other thing that we'd monitor closely is the technical chart pattern. And I tell you what, like a lot of bank stocks, I'm on a monthly view here. Each one of these candlesticks represents a month of time over at Wells Fargo. That's why we can slam forward a ton of price action. You see here a flattening of bank stocks. And a lot of you that maybe are just newer into the markets, you might not remember that bank stocks like Wells Fargo, like Citigroup, like Bank of America, these were some of the hottest investments for a very, very long time on Wall Street. In fact, you went from under $1 per share. I'm sure there's some split adjusted values here with Wells Fargo, but this stock from a split adjusted basis was under $1 per share back in the 80s and 90s and rallied all the way up into $20, $30 per share. Look how steep this rise is on this. With Wells Fargo, and again, this is all before the great financial crisis. Now what you've noticed with bank stocks in particular is they've really started to flatten out. Yes, they continue to rise just a little bit, but we're seeing a flattening out, and this is because of regulation. The Federal Reserve essentially tells these banks if they can do buybacks, if they can raise their dividends, and to what levels they can do that. And we see a push-pull in this environment. Certainly that will impact stocks as an equity investor. Not saying that you don't invest in banks or that you throw them to the side or it's a small portion of your portfolio. Certainly older investors trying to protect their wealth, not necessarily grow their wealth. Bank stocks that essentially have gone sideways while many tech stocks have completely fallen off the map over the last year. Look, an 8% decline on Wells Fargo while you're earning 2% on your money. Not necessarily the worst thing. You could have made way worse decisions with your investments over the past year. Certainly with Wells Fargo, there were those issues a few years ago where they were creating accounts for customers and they were deeply punished from a regulatory perspective from that as well. But we're seeing more recently over the last 6 or 7 years, again, outside this major dump that this stock had to take, the stock's traded in a tight range between about $37 up to about $50 per share. Right now, we're towards, I wouldn't necessarily say the bottom of the range, but you're at a level of support. You're not at a level of support. You're like $4 or $5 over that, but it's not that big of a difference over at Wells Fargo. I would expect us to meet some overhead resistance on this one. This area right at about $44 per share acted as a level of support for a while with Wells Fargo. And quite frankly, once you get over that level, you would expect this one to rally towards the top of this range up over $54 per share. Quite frankly, from a technical perspective, I think there's two ways to play that. If you're not in Wells Fargo and you like the kind of increasing dividends, maybe you're buying this one for the longer term. You're not really looking for capital appreciation. You're just looking to kind of protect your money, grow it over the longer term. Wells Fargo, not necessarily a bad choice. I would push you maybe more into one of these financial ETFs like an XLF or something like that, maybe a Vanguard equivalent. I think that would maybe be a little bit better opportunity. I think if you're going to want to be in Wells Fargo, I think you're going to want to play it a little bit more tactically. I personally think from a technical perspective, you wait for it to come up over $44 per share. If it gets up over $44 per share, I think it's a pretty clear move all the way to at least $49 per share. We've seen that's where it's met a little bit of a resistance, but almost 100% of the time, when you get up to 49, you push all the way up here to $54 per share. Folks, that would be over a $10 rise per share. And that's what the technical chart would tell you if Wells Fargo were to get over this $45 level. Right now, it's sitting kind of in no man's land. I think it's possible we come up here to about $43, $44 per share. You got another $2, $3 in this one. It could meet some resistance here. This is why I wouldn't necessarily run in today and buy Wells Fargo, because yes, you could have some shorter term gains, move to the top of this resistance level. If you want to play that $2 or $3, you're more than welcome to, but there's a possibility we come up to that level, we meet a red bar if you do hit a recession here in the United States. We talked a lot about how maybe we won't hit a recession, maybe mortgage demand picks back up, even though interest rates are essentially double where they were historically over the last 10 years. We talked about how auto loans may not slow down, maybe personal loans slow down. Well, what if the opposite happens? Interest rates continue to climb. They have to get to 6, 7, 8, 9% before this inflation thing tamps down, or the economy slows enough that inflation starts to tamp down. Well, all of a sudden that would put a halt on this consumer business even more. That would deteriorate these earnings even further. I'm not exactly sure Wall Street would absolutely love that. In the case of Wells Fargo, we could hit our head up here at 44 and quite frankly pull back to maybe south of $39, $36, $37 per share. We're in a really tight range over at Wells Fargo. We're in a tight range with a lot of financial stocks, and you just need to recognize that as an investor. If you're going to put your money into this, understand that the way the regulations work with the banks, you are not going to, there's just not going to be a scenario, I think, in the shorter term, where Wells Fargo is able to resume one of these steep uptrends like it had before you had all this banking regulation after the great financial crisis. I just don't see a scenario where that happens with banks. I don't think regulators will allow it. I don't think Wall Street has the appetite for that type of thing. You're more inclined to have kind of a very, very steady and slow growth over at Wells Fargo. Collect those dividends, get those share buybacks in place, build your wealth for the long term. There's certainly positions in portfolios, depending on where you are in your investing career, for investments like that. You just need to understand what you're getting yourself into with these financial stocks like Wells Fargo. I personally think instead of waiting 5, 6, 7, 10 years for my gains with Wells Fargo, I'd rather play the technical bounces on these things and lock in my profits and use those profits to go maybe acquire companies with a higher growth rate. That's where I am at in my investing career. Certainly 10, 15, 20 years from now, we'll probably be singing a slightly different tune here on the channel. Hopefully you guys enjoyed today's video. We'll be back again later today with the Fang Stock Recap Show. Hopefully you guys enjoy your weekend. Good luck with your investments.